Hi, everyone, and thank you for joining us for today's webcast, Forward-Facing Metals, Both Precious and Critical, sponsored by Sprott. Today's webcast will provide one CFP, one IWI, and one CFA CE credit. If you have questions on credit, please give us a call via the number on the console. We welcome and encourage your questions. You can type your question in the Q&A box, and we'll do our best to get to as many of your questions as possible. Materials, including today's presentation, have been made available for download from the document folder at the bottom of your screen. We appreciate your feedback. Please take a moment to take our brief survey that is also located at the bottom of your console. We will be covering quite a bit of information during today's webcast. If at any point in time you are interested in scheduling a one-on-one meeting with Sprott, please click the blue confirm button in the meeting request box on your screen. Lastly, in the event you missed any part of today's webcast or simply would like to watch it again, a replay will be made available and all registrants will receive that information by email. I am pleased to introduce our first speaker, Ed Coyne, Senior Managing Partner, Global Sales at Sprott Inc. I'll now turn it over to Ed to get us started. Ed, welcome. The floor is yours.
Thank you, Melissa, and thank you all today for joining our last webcast of the year. I'm pleased today to welcome both Ryan McIntyre and Steve Schostall, both from Sprott. Ryan serves as a managing partner at Sprott Inc. and Chief Executive Officer of Sprott Family Office, as well as Senior Portfolio Manager at Sprott Asset Management. Prior to Ryan joining Sprott, Ryan brings over 20 years of experience in natural resources sector and was most recently the president of the gold royalty company, Maverix Metals. Prior to Maverix, Ryan spent over 11 years with Tocqueville Asset Management as a co-portfolio manager of Tocqueville Gold Strategy. Ryan holds a Bachelor of Commerce with distinction, majoring in finance from Dalhousie University and an MBA from Yale School of Management. He also holds a CFA designation. I'm also pleased to have Steve join us. Steve joined Sprott Asset Management as Director of ETF Product Management back in April of 2022 and has more than 18 years of experience in the ETF industry. Steve leads the ETF Product Management team in the creation, launch, and ongoing support of Sprott U.S.-listed ETFs. Before joining Sprott, Steve was with ProShares Advisors as a Senior ETF Product Manager. And prior to joining ProShares, Steve held various positions, including ETF positions at Vanguard. Steve earned his Bachelor of Science in Finance and his MBA from Penn State University. For today's webcast, I've asked both Steve and Ryan to join us to talk about very specific and near and dear to our heart topics. I've asked Ryan to talk about precious metals, focusing both on gold and silver. And then we'll turn to Steve to talk about the case for critical minerals, whether it's the generation, the transmission and storage, and the overall highlight of our full suite of energy transition ETFs. Then, before we go to Q&A, I'll briefly talk about how to think about both precious metals and energy transition materials in your portfolio creation. For our newer guests on today's webcast who are not familiar with Sprott, Sprott is a global leader in precious metals and energy transition investments. At Sprott, we offer a full suite of solutions in both precious metals and energy transition materials. With over $25 billion in assets, Sprott is a publicly listed company which trades on both the New York Stock Exchange and the Toronto Stock Exchange under the ticker symbol SII. Within our $25 billion in assets, we have over $20 billion in exchange-listed products, such as our physical bullion trust, which gives you direct exposure to physical gold, silver, platinum, and palladium, as well as our physical uranium trust, giving you direct exposure to physical uranium. We also, within our exchange-listed products, have a full suite of energy transition ETFs, as well as gold mining ETFs focusing on both senior large cap and junior small cap mining stocks. Within our $2+ billion in managed equities, is made up of our flagship U.S. Gold Mutual Fund, our closed-end valued fund, our energy transition critical mineral strategy, as well as the Sprott Hathaway Special Situation Strategy. And lastly, within our private strategies with over $2.5 billion in assets, we offer a full suite of bespoke credit investments to mining and resource companies. So now that we've talked a bit about what we're going to cover today, as well as the firm itself, at this time I'd like to turn the webcast over to Ryan McIntyre to focus on precious metals by highlighting both gold and silver. Ryan?
Excellent. Well, thanks for the introduction, Ed. So you're probably wondering why gold and silver are featured as future-facing metals. So future-facing metals are typically characterized by their scarcity, unique properties, and potential for innovation, and gold and silver have all three. Gold and silver, two of the most coveted precious metals, are renowned for their scarcity and finite supply, which significantly contributes to their enduring value. The rarity of these metals stems from the fact that they cannot be artificially created and are only found in limited quantities within the Earth's crust. This scarcity is exacerbated by the challenging and often costly process of mining, which limits the rate at which these metals can be extracted and brought into the global market. Additionally, the finite nature of gold and silver reserves means that there's a cap on the total number that can ever be mined, making them inherently valuable. Now, gold's unique properties have established it as a globally recognized store of value for thousands of years, a testament to its enduring appeal across various cultures and economies. It is viewed as an inflation hedge, often retains its value or even appreciates during times of economic instability, and exhibits low correlation with other assets like stocks and bonds. Beyond its financial attributes, gold's physical properties are equally remarkable. It boasts exceptional conductivity, making it indispensable in some electronics, and is highly resistant to corrosion. Additionally, gold's malleability allows it to be easily worked into intricate designs in jewelry and industrial applications, further enhancing its practical and aesthetic value. Now, silver's unique properties are very similar to gold's, but it has more of a balance between industrial and monetary functions, whereas gold is almost uniquely viewed as a monetary metal. From a monetary standpoint, silver is also viewed as an inflation hedge, a safe haven asset, and exhibits low correlation with other asset classes. But silver also has exceptional physical and chemical properties, making it a highly versatile and valuable metal, particularly in today's world. Many don't know this, but it is the best electrical conductor of all metals, a characteristic that makes it indispensable in numerous electronic and electrical applications, from conductors and contacts to high-tech devices. This conductivity is paired with remarkable malleability and ductility, allowing silver to be easily worked into thin sheets or drawn into fine wire, ideal for intricate designs in jewelry and industrial components. Silver also possesses potent antibacterial properties, which are harnessed in medical and hygienic applications, ranging from wound dressings to coatings that inhibit microbial growth. Lastly, its optical properties are notable. Silver's ability to reflect light makes it valuable in mirrors, solar panels, and specialized optics. And I'll touch more on solar later, given its tremendous growth and outlook. Historically, gold's physical form presented challenges in terms of storage, security, and liquidity. The introduction of the first gold ETF in 2003 marked a significant shift, allowing investors to hold gold in a more accessible form. Now, other fintech solutions, such as the blockchain technology, could further revolutionize gold ownership yet again. In today's world, it is clear that people are increasingly seeking a store of value that remains independent of external institutions. Gold is the perfect underlying asset for this, and having additional avenues to access gold will only increase its appeal going forward. Silver, on the other hand, will also capitalize on this, but its more immediate future is focused on the industrial demand side, with the growth in renewable energy, electronics, and medical applications. Next slide, please. Now, gold scarcity is a key aspect of its allure and value. It is estimated that all gold ever mined would only fill about 3 Olympic-sized swimming pools. This rarity stems from the fact that gold is not evenly distributed in Earth's crust and is often found in very low concentrations, making its extraction both challenging and expensive. The The supply of gold is limited and grows only incrementally each year, as you can see. For reference, mine supply only adds about 1.5% to the existing stock of gold each year. And as you can see in this chart, mine production has been flat for the past 7 years. This is largely due to the depletion of easily accessible gold reserves and increasingly regulatory, environmental, social, and economic hurdles that one must pass to get into production. 90% of the demand of gold is split between two categories, investment and jewelry. We'll go over gold's investment attributes in the next several slides, but notably, gold jewelry has the typical components of desires such as aesthetic appeal, cultural significance, and as a status symbol, but can also be viewed as an investment given its metal is easily assessed and attained if desired. Next slide, please. One of the things that typically surprises most investors is gold's solid long-term price performance. Since the United States abandoned the gold standard in 1971, gold's price, measured in U.S. dollars, has seen annual growth rate of almost 8%. Moreover, gold has outperformed many significant asset classes start of this century. This is particularly notable in relation to the S&P 500, which has had very good performance over the past several years and is actually now trading at a 31 times multiple using the Shiller cyclically adjusted price-to-earnings ratio, which has historically only traded at 17 times. Next slide, please. In addition to having good returns, gold's volatility has been relatively low compared against other asset classes, as you can see. Gold is a highly liquid asset, which can easily be bought and sold, and this characteristic is especially beneficial in periods of financial stress, when quick and efficient transactions may be essential. Gold's high liquidity also ensures its value is maintained with minimal transaction costs. The ease with which gold can be bought and sold ensures that any significant price movements are quickly corrected, further contributing to its low volatility. Next slide, please. Now, slide 10 shows that gold often behaves independently from other asset classes. Incorporating gold into an investment portfolio can enhance the portfolio's efficiency frontier, a concept in modern portfolio theory that represents the optimal balance of risk and return. By including gold, investors can potentially achieve a more efficient portfolio, one that provides higher expected returns for a given level of risk or a lower level of risk for a given expected return. The presence of gold in the portfolio can contribute to smoothing out the volatility and enhancing long-term returns, shifting the efficiency frontier upwards and to the left, which is generally considered more desirable in portfolio optimization. Next slide, please. Now, for thousands of years, gold has been recognized as a store of value, a belief that continues today. As a physical commodity, gold has intrinsic value, unlike paper money or digital assets. Gold is traditionally viewed as an inflation hedge, maintaining its value or even appreciating during times of inflation, when currency values tend to decline. In periods of economic turbulence or geopolitical uncertainty, like we've witnessed recently, many investors turn to gold as a safe haven asset. As can be seen in this chart, during the 7 crisis periods since 2007, on average, gold has returned 12% compared to only 4% for U.S. Treasuries and minus 13% for the S&P 500 during these times of crises. So a good thing to have in one's portfolio. Next slide, please. Now, one of the reasons we think gold will become increasingly sought after relates to the dire public finances of many large economies around the world. The United States is a great example of this because it faces a precarious fiscal picture with persistently high deficits and a large federal debt. This unsustainable trajectory raises concerns about the nation's ability to meet its financial obligations without significant money printing, leading to the increase in sovereign risk. The rising debt burden increases interest payments, consuming an ever larger portion of the budget and squeezing resources available for other critical areas. Additionally, demographic trends of an aging population exert further pressure on entitlement programs like Social Security and Medicare, pushing long-term fiscal imbalances even further. Addressing these challenges requires decisive action from policymakers to reform spending and prioritize long-term fiscal stability. However, as we have witnessed repeatedly in recent years, the United States government has been increasingly fractured and is largely taking a short-term view on many things. Failure to act could lead to significant economic consequences, including reduced access to credit, higher interest rates, or potentially even a debt crisis. In today's divided world, people are increasingly desiring independent store of value, and as such, gold, in our view, will become increasingly relevant as people look to protect themselves from external risks. We are already seeing this in certain parts of the market. Next slide, please. Most notably, and actually ironically, we've seen the shift in attitude with central banks already. For 13 consecutive years, central banks have steadily increased their holdings in gold, culminating in record-breaking purchases of over 1,000 tons in 2022, which is approximately double what they had been purchasing prior to that. In fact, it was the most of any year, any records going back to 1950, according to the World Gold Council. Year to date, central banks have purchased approximately 800 tons, so if you annualize this number, it'll be over 1,000 tons again for 2023. And the big purchases so far this year have been China, Poland, and Singapore. The one question we often get from investors is how much gold exposure should I have in my portfolio? As a general recommendation, we suggest investing 10 to 15% of a diversified portfolio in gold and gold-related equities. We think 10% should be allocated towards physical gold, typically the more conservative option in the gold allocation. And anywhere from 0 to 5% could be allocated to gold-related equities, which I'll talk about in a little bit. This is generally considered the more aggressive option in a gold allocation, aiming to offer leverage to gold prices and the potential for high returns, albeit with increased risk levels. Next slide, please.
Hey, Ryan, this is Ed Coyne. I think this slide deserves a bit more conversation around how should an investor read into central banks buying more gold? In your mind, as a portfolio manager, what is that telling you?
What it's telling me is that they're not comfortable with strictly holding fiat currencies at the present time. And I think there are a couple different reasons for that. I think, one of them is clearly, the perpetual debasement of a fiat currency. So the purchasing power of any currency in the world has depreciated over time. And so I think that's sort of level one. And then what we've witnessed recently, particularly over the past 2 or 3 years, is you've had, places where they've confiscated the currency or frozen assets of certain currencies, so not allowing people to transact. Russia obviously would have this notable experience in all of that. And, moving away from that, to gold, for example, gets them away from anybody actually controlling the outcome of what they want to do with their money. And again, we've had recent meetings with, the BRICS group of countries, talking about this very issue of, creating their own currency or currency basket or that type of thing, or at least moving outside of the traditional, U.S. dollars being the base currency. And, I think they're exactly portraying, what other independent people are thinking, like ordinary citizens like you and me, who frankly just want something that's a store of value that someone just can't, confiscate or freeze overnight.
Yeah, that's helpful. I just thought it was worth, highlighting that a bit because so often investors aren't really thinking about central banks, and we live and breathe that every day. So I thought that was something worth just reiterating. So thank you for that.
Yeah, no, absolutely. So just on slide 14 here, so just talking about some of the gold equities. So we think about gold equities like any other specialty sector and other cyclical industries. We believe it's prudent to actually capitalize on the cycles and potential mispricing. So basically what we're recommending is buying gold equities when they're out of favor and selling them when they're in high demand. And as you can see in the chart here, which tracks the enterprise value per ounce of resource divided by the gold price, shows really that gold equities appear to be at a cyclical low and worth considering for your portfolio. Now, ownership in gold equities provides leverage to the gold price. So when the gold price rises, the profits of these companies tend to increase significantly, leading to large gains for investors through the share price. And conversely, when gold prices fall, losses can be amplified the other way as well. So it's important to buy these cyclical lows. And typically, gold equities offer about twice the short to medium term return of gold prices. So if you were to mention that gold price is going to go up 1%, we would expect gold equities to go approximately 2% and vice versa. The other element that gold equities add is they have the potential for growth. And so any new discovery of new gold reserves by a mining company can also add considerable value. And it's one advantage, actually, that obviously physical gold doesn't possess. An ounce of physical gold will always be an ounce of physical gold. And the other aspect to mention is that the life cycle of a gold mining company is really segmented into three different stages. There's the discovery stage, the development stage, and the production stage. And the most value-enhancing stages really occur during the discovery and then the mining company's transition from development to production. And so these are independent parts of the cycle here where you can really take advantage of value addition to gold equities. So these companies also have some operational risks that you have to deal with. So obviously there's technical and geological risks, geopolitical risks if the mines are in unstable regions, and obviously market risks given extreme volatility with stock prices potentially. And contrary to physical gold as well, which does not yield any income, gold-related equities have the potential to pay dividends. So right now the NYSE Arca Gold Miners Index is yielding about 2.6%, which is notably higher than the 1.7% from the S&P 500. So it actually provides solid income relative to the S&P 500. Next slide, please. Now let's move over to silver. And as you can see in these charts, over the past decade, silver mine production has experienced a notable decline, a trend that really contrasts sharply with the increasing demand, especially in industrial applications. The same factors that have impacted gold production, such as depleting ore grades, operational challenges, and environmental and regulatory constraints, have been contributors to the reduced output of silver. But it is also worth noting that 80% of silver supply is actually a byproduct of lead, zinc, copper, and gold production. And notably today, anyway, lead and zinc prices are reasonably low. So many of these mines actually are barely profitable. So it's really unlikely that you get any new investment into new mines. So very unlikely that additional silver production will come on stream anytime soon. Next slide, please. Now, from the demand side, silver's exceptional electrical and thermal conductivity, along with its reflective and antimicrobial properties, make it invaluable in numerous applications. It's extensively used in the manufacturing of solar panels, electronics, and in emerging technologies such as electrical vehicles, 5G networks. And the growing industrial demand, coupled with the decline in mine production, has really led to a significant tightening in the market for silver, leading to potential impacts on its price now and in the future. And the dynamics of the global market continue to evolve and accept the idea that there's going to be likely these deficits going forward. Specifically, as global efforts accelerate towards energy transition, the swift advancement of solar technology stands out as a crucial element here. Now, solar panels have become a pivotal element in the shift towards clean, sustainable, and reliable energy solutions, as you'll see in the next slide. Next slide, please. So today, solar panels are becoming increasingly dominant due to their ability to generate clean energy efficiently and cost-effectively, and coupled with their low environmental impact and long lifespan of over 25 years. The chart on this page shows the evolving global mix of electricity production around the world going forward, and it clearly shows that solar will be taking a larger share of this growing market. In fact, the International Energy Agency predicts solar energy capacity will outpace all other energy sources, with solar expected to contribute 98% of the global electricity capacity expansion by 2030. Elon Musk actually is also really bullish on solar, and actually just mentioned in a podcast about a month ago, he actually talked about the idea of powering the entire United States by a 100-mile by 100-mile section of solar panels. So clearly this has a lot of potential here, and overall the potential surge in solar market will likely lead to a significant increase in demand for silver, potentially leading to this continued supply-demand imbalance may be exacerbated going forward. Next slide, please. As you can see on slide 18 here, there's been a significant deficit of silver over the past several years. Deficits currently have been addressed, frankly, by depleting silver stocks that exist currently. But when you look ahead, we continue to see deficits going forward in the sector with very little ability for new supply. And so we really see this could very positively impact the price of silver moving forward. Next slide, please. Now, as previously mentioned, silver is often compared to gold, and because of this, many compare its price relative to gold. Historically, the gold price has been about 60 times that of silver, a ratio that serves as a benchmark for comparing the relative values. And currently, the gold-silver ratio stands at about 81, suggesting that silver is relatively less expensive gold. And the current price, well, today it's about $24 or so. But we could see that moving into the mid-30s if that average was maintained at some point in the future that it has historically. Next slide, please. Now, in addition to physical silver, there's also the ability to buy silver stocks, just like in the case of gold. And silver stocks currently present an attractive opportunity, as you can see, as they seem to be valued again at their low point in their cycle, so perfect time to take a look. These stocks also provide a distinctive mix of benefits like the gold, so growth prospects, addition of silver reserves or production, and potential dividend payouts as well, particularly as the silver price might increase. And so the one thing to note here with silver versus gold, typically you get a little bit more price volatility, and so you'd even expect a further level of amplified gains if silver were to go up, and conversely the opposite is also true on the downside as well. So anyway, I'll leave it at that with gold and silver, and I'll turn it over to Steve to talk about critical metals.
And Ryan, before we have Steve talk about the case for critical minerals, could you just answer the question of why do you think there's this ongoing disconnect between the price of physical metals like gold and silver relative to the opportunities or valuations within the mining equities themselves? Could you maybe shed some light on that for our listeners as well, why you think that disconnect continues to today?
Yeah. Well, I think it's easier for most investors, and it's sort of the first entry into the precious metal space typically to start with just the physical commodity itself first. It's obviously, lower volatility, easier to manage. You don't have to worry about various country risks and so forth. And so I think people are doing that. And from the equity side, I definitely think that the valuations have disconnected from the prices. And I think it's going to take, a couple different factors. One that's starting to kind of happen now with inflation slowing down, because you also had, in recent periods, you've had, pretty steep increases in inflation, which obviously impacts the costs for the mining companies. But what's interesting now is you've seen, let's say the price of gold and silver move up a little bit over the last several months. And you've also seen in tandem, you've actually seen a decrease in the inflation numbers, which is great for the producing companies. So I'd actually expect for probably the first time in a while for actually margins to start expanding a little bit more, which is exactly what you want to see. And typically when that happens, the share prices go up as well. So I think we're at the very early stages of that piece of the equation.
So stay tuned is what it sounds like to me.
You got it.
Great, thank you. And Ryan will be available for Q&A towards the end of the webcast as well. But before we go to that, I'd like to now turn it over to Steve to talk about the case for critical minerals. Steve?
Hey, thanks, Ed. So what I'd like to do is just spend a few slides talking about the energy transition from a bigger picture and understand exactly what we mean when we say that, because the energy transition can mean different things to different people, and want to just level set before we jump right into what the opportunities are. If you were to look at, go back through human history, society is always looking for a way to find not only new energy sources to diversify their energy sources, but we're also looking at ways in which we can increase energy efficiency. And we're kind of at that next step in our energy transition. It's something that's been talked about now, I'd say, for the better part of 30 or 40 years. Where do we move from fossil fuels? It's been a while now since nuclear actually started really coming into commercial use in the 1960s, and we're starting to see that take a more prominent role, and we'll touch on that in a minute. But if we could go back just one slide for a second here. How do we view the energy transition? So one thing that we think is a complete move away from fossil fuels. We believe that, at least for the foreseeable future, several decades out, that fossil fuels are going to continue to play a very important role in how we get energy. And as we start to shift to more renewable sources, things like nuclear power, we think, are going to see a renewed interest, and we have some relatively breaking news on that we'll discuss as we go throughout. We're also going to see a increased need for battery storage, and things like lithium and cobalt and graphite and nickel will be used for those, particularly as it relates to EVs and the way we change in which we move around society. So on the next slide, I'd just like to take just a second and talk about, from a graphical perspective, I think it's quite interesting to look at how the investment in the energy transition has changed over time. So if you were to go back, to the early part of this decade, you'd see somewhere between around $500 to $600 million a year was being spent on the energy transition. And in the last 2 years, we've actually seen a very significant rise in spending and investment. So just looking at 2022 as an example, that $1.1 trillion that was invested on a global scale is significant, one, because it's the first time we crossed that $1 trillion threshold, and then secondly, because it's the first time that investments in the energy transition were actually on par with investments in fossil fuels. So as we move through the energy transition, we expect to see these yearly investments continue to increase at a rate that's going to be, if we were to look back 10 years from now, would be significantly different than where we're at today. So the next slide, I'd just like to focus a little bit on one thing that often gets overlooked when we start thinking about the energy transition. So anytime you start to build up a new industry, a lot of focus gets placed on the cost and the investment that's needed. If we look at the other side and actually look at the revenue that's coming from different aspects of the energy transition, what we can see is that it's actually accounting for about 2.6% of global GDP. So not only is this a growing sector, it's already a significant contributor to economic activity across the globe. And if we were to look at the 8,000 or so companies that are heavily involved in the energy transition, we'd see revenues of around $2.5 trillion. A lot of that, not surprisingly, is dedicated to electrified transportation, whether that's EV passenger vehicles, or if we're looking at like public forms of transportation, or maybe light trucks. But I think something that a lot of people find surprising is actually the second largest revenue generator there is in nuclear power. And we'll spend some time on that as we go through the next few slides. Next slide, please. So when we look at the energy transition, we talked about investment. So basically what's happening, we're really at this critical juncture where we really have to keep feeding this fire to keep the ball moving forward. So things like COVID-19 and the ongoing war in Ukraine, some of the political moves and geographical moves that you're seeing by Russia and China are really starting to shape how predominantly Western countries are looking at the energy transition. One thing that Russia and China are looking to do specifically is they're trying to gain influence into these resource-rich countries in Africa and South America. You'll see that as they're trying to, one, either go in and mine the materials that is there so that they can send it back and process it and try to remain a leader in that market, or else they're actually investing further down the supply chain within each individual market so that they can get access to those minerals. So in the United States and Europe and Canada and many Western countries, Australia, we're seeing a concerted effort really to prioritize securing the critical minerals, particularly as it relates to battery metals and uranium. There's also a growing openness that we're seeing to the uranium sector and nuclear industry, which is why we're seeing some increased investment there. And if you were to look at the United States and energy production, you would see that nuclear energy actually accounts for about 18% of the U.S.'s energy production. We're actually seeing legislation move through Congress. The Inflation Reduction Act, which was passed not too long ago, actually provided $369 billion in incentives to build out clean energy infrastructure in the United States. That's the official estimate. If you were to look at other non-government estimates, many have that approaching the $900 million to $1 trillion over the course of the next decade. So significant amount of money coming not only from private sources, but also public sources. And then finally, one aspect of this is this notion of reshoring, where countries that are aligned politically are looking to work with each other to make sure that we have secure supply chains. And going forward, that's going to play an increasingly important role as companies look to build out various aspects, whether it's the EV infrastructure or battery manufacturing plants. Sourcing those minerals from those quote-unquote friendly countries is something that's going to become increasingly important. Next slide, please. So to put a picture on what that government investment looks like, one of the things I appreciate about this graph is if we look at the 12-month period since the Inflation Reduction Act was signed, there's actually been more than 100 new clean tech manufacturing announcements worth about $80 billion in total investments that have been made in the U.S. So a lot of that is coming from U.S. and European countries. We also do see significant investment coming from Japan and South Korea, particularly as it relates to the battery manufacturing process, with both of those countries being leaders in that space. What we're actually seeing, if you look from those large red dots, those not only does the size of the dot show how big a project is, but the color will show you what it's invested in. So those large red dots are large projects that are dedicated to battery manufacturing. And what we're seeing is the emergence of a battery belt of sorts from Michigan the whole way down to Georgia. A lot of that is incentivized by federal money, but we're also seeing on a state level that governments are looking to build out these industries in their states as they look to increase their taxable receipts and grow their populations. We're actually seeing a pretty significant competition from many states to bring those jobs in their localities. Next slide, please. And so we'll take some time here, and on the next slide, we're going to kind of lay out the framework on how we view the energy transition. We basically look at it in three separate buckets. The first being the generation side. So Ryan did a great job covering silver and talked about its use in the solar panels. And I think probably my favorite silver stat that many people don't realize is that about 10% of the silver that's mined is actually used in the solar panel industry. So it's a lot higher than I think most people would imagine. Rare earths are very important to their use in not only windmills and the wind turbines, given their magnetic properties, but also in the EV manufacturing process. Your EVs that you see going down the road will use a number of rare earths to help propel the engine forward. And then, of course, we have uranium there. On the transmission side, we have copper. That's really the metal that kind of ties this whole energy transition together, as you know, given its ability to conduct electricity efficiently and its abundance around the earth, and basically is prevalent in anything that has electricity flowing through it, whether it's a smartphone or power grid or a solar farm. And then finally, on the storage side, this pertains mostly to EVs and the batteries for EVs, although we do see some applications coming up for storing electricity from solar and wind farms for periods when they're not generating power. Lithium, nickel, manganese, cobalt, and graphite are the predominant metals that we see there. We will discuss lithium a little bit more in greater detail as we move forward here. Moving to the next slide. So at the same time that we have this energy transition going, we have this backdrop of electricity demand setting to almost double by the time we get out to 2050 relative to 2022. So with an 86% expected increase in electricity demand, that's being driven largely by two different factors. So one would be In more developed countries, we're seeing needs for technological innovation. So as we move to EVs, that requires more energy output to, set up charging infrastructure so that the EVs can be powered. And then when you look at more developing countries, we would expect to see an emergence of a middle class as investments start to be made in those countries, where we think that we'll start to see the increased demand for electricity come out of countries where you wouldn't expect that to be, if you just look 10 or 15 years in the past. Moving to the next slide. One of the things that we like to focus on the generation side is uranium, and that's for a few key reasons. So one, uranium's the primary fuel source in nuclear energy, and it has the distinction of being not only a very reliable source of energy, really the only time that you have to turn the power off from a nuclear power plant would be when you're refueling and restocking the uranium within a nuclear reactor. Other than that, it's an energy source that's very reliable, is essentially always on, and what we refer to as providing reliable baseload power. When you start to look at things like wind, like solar, and other forms of energy that are reliant on natural factors, whether the sun's shining or the wind blowing, you see that, if you look at solar's case, for example, the second bar from the right, they could have significant periods of downtime. And, if you have periods of overcast days where the sun's not shining, or just, depending where you're located from a geographic perspective, the amount of sunlight that they get even during daytime can limit how much power is being produced. The second thing about nuclear and why we think that it will continue to be a centerpiece for many governments as we look to transition is how clean it is. If you look at nuclear, wind, solar, and hydro and other forms of clean energy, it's essentially a carbon-free way of getting energy. And some of the news that just came out of the COP28 conference last week was 22 countries actually pledged to triple their energy output from nuclear energy by 2050. So this is a significant step toward adding nuclear energy to our mix that, if you go back 2 or 3 years ago, probably wouldn't have been as likely and would have been something that would have been a much bigger surprise. But this is a big announcement that just came out. And within that pledge, it includes commitments to not only mobilize investments in the nuclear power industry, but it's also looking to develop new forms of nuclear power that might be able, like SMRs or small modular reactors, that could use much less real estate and be much more localized and allow more reactors around geographies and not necessarily rely on these huge nuclear power stations that we're accustomed to seeing. The second thing that this pledge actually looks to do is encourage the World Bank to include nuclear energy in its lending policies. And that would allow countries that might not have the financial condition that many developed countries have to increase their usage of nuclear energy. Next slide, please. One of the things I think that surprises many people prior to, I'd say, this July, the things that we heard most, I would say, as we talk to clients, is that the U.S. hasn't built any nuclear power plants for the last several decades. It's not a focus here. Is there really an investment case to be made here? So in July, we actually, in Georgia, had a nuclear power plant actually go online. We expect to have another expansion of that plant go up in early part of next year. But up until now, the nuclear story really has been an international one. So when you look at the operational reactors around the globe, the U.S. currently leads in nuclear production. There's about 434 reactors around the globe. But if we look at reactors that are under construction currently, that's another 59 reactors. And looking at the chart here, you can see that most of that is predominantly in China. But we also have a significant amount, 111 reactors that are already planned for construction. So not only are we seeing Asia as a primary growth driver here, if you look back to North America, we're starting to see more and more plans being made to bring nuclear power online. One thing this chart doesn't capture is the nuclear restarts, or the plants that are already currently running and expecting to decommission, having their lives extended. So if you think about Japan, for example, a lot of their nuclear power production was cut back after Fukushima. They're actually taking a leadership role in moving forward. They're restarting their reactors. And of the 22 nations that signed that COP28 agreement, Japan was actually one of the signatories there. So we're seeing some, encouraging signs from places that many people might not think are taking place, but governments are starting to wake up to the fact that any sort of energy transition or heavily reliance on green energy is actually going to come in the form of nuclear energy. Next slide, please. So I just want to take a brief minute and look at the supply and demand dynamics that we're seeing here for uranium. We've had basically a lost decade of underinvestment in the uranium industry. Prices just weren't at a price that really would cause companies to invest in the space. And what happened was that really created a tight market and in the spot market. So we're now at a point where utilities were able to spend the better part of the last decade or longer actually drawing down stockpiles of uranium as the stockpiles became available after the Cold War. Now utilities are at a point where they are starting to really go back and market and force and produce and purchase more uranium. If we were to look at 2022, about 125 million pounds of uranium were bought by utilities, which was the highest amount in 10 years. But as large of a number as that is, that's nowhere near the 180 million pounds a year that need to be purchased by utilities given today's nuclear makeup in order to fully replenish their supplies. So we think that what we'll see over the next 12 months or so is that global production will reach about 150 million pounds. And if we were to look out through 2040, as this chart shows here, the World Nuclear Association expects requirements to actually get up closer to 300 million pounds by the end of next decade. And so what's really driving the movement that we've seen in uranium recently is it's one of the best performing asset classes, up close to 70% over the year, is these utilities really have to come back into the market and are replenishing that supply. And if you were to look at the production versus demand out through 2040, and if you were to add up all of the production deficit, you would see something close to 1.5 billion pounds of underproduction over the next 16 years or so. Next slide, please. So we'll take just a few moments here, and we'll move over to the transmission and storage side. So on the next slide, one of the things we like to show is on the left-hand column we have the various critical minerals, and across the top we have the different uses for those minerals. So we'll focus on this next section mostly on that electric vehicle column there, where you can see lithium, copper, nickel all are playing fairly prevalent roles in EVs, as well as manganese, cobalt, graphite, and rare earths. And then copper, we'll also take a few moments to speak about that. As you can see on that third line down, it pretty much extends across the energy transition, has a huge role to play. Next slide, please. One thing I'd just like to point out is if you look at an internal combustion engine car, so fossil fuel powered car, you would see there's about, if you convert this to pounds, you're looking at about 70 pounds of different critical minerals that are needed for your everyday average gas-powered car. If we look at an EV, you would see that you're starting to get closer over that 400-pound usage for all of these various critical minerals that we have listed out there. Prominently among these are copper, graphite, lithium, and nickel's also playing an increasingly important role there. So a lot of materials needs to be used to produce these electric vehicles, and we'll talk about the growth of that in just a second, versus what we see with the gas-powered cars. Next slide, please. So unsurprisingly, in the last several years, we've seen a ramp up in the EVs. It's if you go back 7 or 8 years ago, I remember my first time seeing a Tesla. You didn't see them too frequently. Now they seem to be all over the place. And we have all the major manufacturers now, most by, I'd say, 2035, have said that they'll move away from producing fossil or gas-powered cars and move strictly to EVs Some places are doing that based on government mandate. We see that in California. We see that in Europe and some other states here in the United States as well. Others are doing it of their own accord as early as 2030, so ahead of those expected timelines. So the interesting thing here is not only that we're up to 10.5 million EVs that were produced last year and sold, it's just that hockey stick type pattern that we're starting to see as we move along this transition. So on the next slide, one of the things I like to point out is that this takes a look at sales of electric vehicles, designated by the green lines in the first column, internal combustion engines, and then all passenger sales, if we combine those two in the right-hand column. Not surprisingly, Southeast Asia, India, China, and Japan, given their the amount of urbanization that they have in many parts of these countries and how close they are to the battery production process, are all kind of leading in their growth in electric vehicle sales. To me, what I find very interesting is that center blue line. With the exception of Australia and Southeast Asia and India, a lot of these major economies are actually decreasing their sales of gas-powered cars. A couple reasons for that could be, one, EVs are starting to take over. There's more incentives for EVs and for purchasers to buy EVs through subsidies and things like that. The other is it's if you look at current interest rates, it's getting more and more expensive to finance a car. As if you go back 2 years ago, you could probably get a 0% financing deal. Now you could be looking at 5, 6, 7% or even higher. So that's weighing somewhat on vehicle sales as well. But the interesting thing to point here is at the very bottom of this page. If you look at the EV column, we see a 62% growth on the global scale expected for this year. If you look at gas-powered cars, we're actually expecting contraction of about 4%. When you put all that together, it's pretty clear to see that EVs are actually, even though it's a meager growth of about 2% in all passenger car sales, that's being driven by EVs. Next slide, please. So we'll spend another moment here on copper, and then we'll move to lithium. One of the things about copper is, this is a metal that's been around and been used for thousands of years. It's actually the third largest metals market in the U.S. By dollar volume. It's only behind iron ore and gold, so it accounts for about $183 billion in the mined activity. So its large market size and wide-ranging applications have historically made it a barometer for the global economy. And many people look to copper to understand where they think the economy is moving to. If you look at the previous commodity supercycle, if we were to go back to the early part of the century, you would see that the growth in copper usage really ramped up, and that was largely driven by the industrialization of China. And that really started to give way to a new supercycle in many commodities. So copper's been recognized by many countries, including Canada, the U.S., and Europe, as a critical mineral, and countries are incentivizing its production. And the reason that it's playing such a prominent role as it relates to the energy transition is because of its high conductivity. So it's able to efficiently move electricity as needed over long distances with little loss to the electrical capacity. And we would anticipate that if we were to look at how much has to be invested into the electricity grid to meet the net zero requirements by 2050 laid out by nearly 100 countries, we would have to see about a $630 billion a year of investment the whole way through 2030. And that's just to stay on track for targets. So that's basically about 2.3 times what we're seeing over 2022's levels. And as you'll see, if you were to look at that horizontal orangish colored line going across the screen, copper has run into some issues as supply issues that are expected to continue for quite some time. We're at a period now where all the easy copper has been taken out of the ground, and we're facing declining ore grades. So today, you would see about 1% of the material being pulled out of the ground as having copper. Traditionally, it's been about 5% when you're looking at the copper mines about 150 years ago. So all the easy copper has been taken. We're also seeing additional social issues in some parts of the country that are mineral rich in trying to mine copper. We see this most recently in Panama, where First Quantum had to have their mine shut down as the Supreme Court ruled against their mining rights because the citizens of Panama didn't like the contract. So that was actually a severe hit to the copper production, about 1% of annual expected production coming out. If you look at Anglo American, they actually just reduced their copper production by somewhere between 200,000 to 300,000 tons of copper for a year, or for this year, or I'm sorry, 2024, and then going out again through 2025. We would expect even more decreases in production from them. So that's a struggle that we have, and something that higher prices will hopefully help incentivize more production. You can see just the last comment here on copper before we move on, that as we move through the next decade and a half to 2 decades, the share of energy transition related activities are actually resulting in higher uses of copper. So that's something that we'll keep an eye on as we continue to move forward. Moving to the next slide. Just really quickly on this slide, a quick graphical representation of how we expect to see demand growth related to the energy transition for many critical minerals. You can see lithium has about a 15 times demand demand projection growth out through 2040. Copper seems somewhat more muted as you're approaching that 2 to 3 times. The reason for that is just the vastness and size of the copper market. That's a significant amount of copper when we look at overall production. And then moving to the next slide. So quickly, we'll just run through lithium. So if you were to look on the left-hand side up until about 2025 or 2026 or so, we would expect to have a period of a lithium surplus. And then from 2026 onwards, we expect to be in a structural deficit. We do anticipate as prices increase over time and would incentivize more miners to come to market, that we would find, and also technological advances in the way in which we mine lithium, that we will be able to bring more production online. But most recently, lithium's had a fairly rough year as it goes in terms of performance. But from our position, given the newness of many of these industries and the amount of growth that's required, that volatility is not unexpected, particularly in the short term. For us, we advise clients to look at the longer term and not necessarily be as concerned about short-term supply and demand disruptions or price movements. Next slide, please. And so we'll just take a brief moment here, and we'll talk about our energy transition suite on this slide here. So we've actually built a suite here that we think really captures the essence of the energy transition. Our focus is on upstream companies that are in the supply chain. So we're focusing strictly on the miners that are bringing these critical minerals to market and leaving out battery manufacturers or EV companies. Our thought is if we can focus on the upstream part of the supply chain, we don't necessarily have to pick winners and losers as it relates to downstream companies. Like if you were to look at a battery manufacturer, for example, there's all sorts of different battery chemistries that you could have, but the one commonality between those chemistries is lithium. So for us, instead of figuring out which chemistry might be the battery makeup of the future, we'll focus on lithium, which is common to all those. We have a screen that allows for a pure play selection of these companies. So we're looking at generally companies, if you look at SETM, there are Energy Transition Materials ETF. We're looking at companies that get at least 50% of their revenue or have 50% of their assets tied to one of the critical minerals of the index. And in SETM's case, we follow 9 critical minerals. That's silver, uranium, rare earths, copper, nickel, lithium, graphite, and manganese, and cobalt are the 9 that are tracked by that index. So for us, that's kind of the one-size-fits-all approach to somebody that understands the energy transition thesis, but doesn't necessarily feel that they have the information to pick the winners and losers between the different metals. And one other aspect I'd like to focus on here before we move on is our uranium suite. So we have a very comprehensive uranium suite, and making up a significant amount of assets in the space. If you look at our physical uranium fund, it's a closed-end fund listed in Canada, available for trading in the U.S. It's about a $5 billion fund that just stores physical uranium, so it's 100% uranium-backed. URNM, which is our Sprott Uranium Miners ETF, is an all-cap ETF, which includes pure play exposure to the mining companies, as well as about a 15 to 17% allocation to the physical uranium product. And then finally, in the uranium suite, ticker URNJ is our Sprott Junior Uranium Miners ETF. This fund launched earlier this year in February and has accumulated about $200 million in assets already, and focuses on those smaller cap names, the more exploration type companies within the uranium sector. Oftentimes those junior miners can be takeout targets for the larger miners, as it can often be much faster and easier and cost effective for a larger mining company to buy an exploration company that might not be producing but has the rights to valuable resources. And just finally, one last slide for me before handing it over to Ed, just to kind of recap our product lineup. So, we really do focus on the pure play side of the equation, where you might look at some other strategies out there that, are upstream, they're downstream. Maybe it's they include companies that have just, a couple percent of allocation to one of the critical minerals. We're making sure that the companies that are included in these strategies, that the energy transition, the minerals that they're bringing out of the ground are core to their business. And, the last thing we want is to have a uranium company, for example, that is also involved in mining other things, and uranium is just a small piece of what they do. And then finally, we have the most extensive lineup of ETFs dedicated to this space. And by having that ETF wrapper, it really is a convenient liquid way for investors to get access to the theme instead of picking which individual companies within each of these minerals that they would like to specialize in. And just finally, we spent the last several decades growing out our expertise in the mining industry, and we're really harnessing that as we go through twice a year to pick those companies for inclusion in the index. We're really relying on that expertise to provide a product out there that's representative to the opportunity. And with that, I'll hand it back to Ed.
Great. Thank you, Steve. And this may be the first. We've broken through the full hour. Rest assured, we've gotten a lot of questions. I do still want to, for those that want to stay on, I still do want to address a few of the questions that have come across, but we will also be responding to all the questions via phone call and or emails to each one that did pose a question. So any questions that were posed today, we will be responding to those. But what I would like to do before we go to Q&A is just talk a little bit about how to address potentially putting today's topics into action when you are building out a portfolio. And starting off with what Steve just talked about, the energy transition ETF. Energy now represents more than 10% of the S&P 500's estimated net income, up from a little over 6.5% in 2022. Yet its weighting is only 4% as of June 30th of this year. So we recommend that the Sprott Energy Transition suite of ETFs may be considered for that overall energy allocation, to complete that allocation, to have it be better represented in the overall portfolio. So we think the suite of offerings we have today could potentially offer you a way to allocate to this opportunity, which we're seeing from an income standpoint becoming a bigger and bigger part of the S&P. And then as it relates to what Ryan talked about, both on gold and silver, from an exposure standpoint, again, depending on how opportunistic your portfolio looks, on a conservative side, you may only need about 5% of gold. But on an opportunistic side, you might need as much as 10 or 15%. And as Ryan mentioned, speckling that with both physical and mining stocks. We've seen time and time again that gold, from a liquidity standpoint and from a resilience standpoint, has been a wonderful safe haven asset that has been proven over and over again when you see volatility in the market and zigs and zags in the market. And more of our investors we're seeing use gold, and to a lesser extent silver, is part of their fixed income and or cash portion of their portfolio, as we see with central banks and so forth, gold is becoming more and more, once again, an alternative currency. And then as it relates to the full product suite, as Steve already touched on, Sprott offers a full suite of solutions, whether you're looking to capture opportunities within the energy transition market and or the gold and silver market on the physical side or on the equity side. I would encourage you to reach out to our Sprott client side, service team. For those that are on the institutional side or the broker-dealer side, you can see your respective contacts here. And for those on the financial advisor side, dealing directly with individual clients, I would encourage you to reach out to Sergio and Matt to talk about how we could work with you all and help you allocate potentially to your portfolio and take advantage of the opportunities that we're clearly seeing in this space. So before we go to Q&A, I'd like to briefly turn it back to Melissa, and then we'll go through a few of the questions that came in across the board. Melissa?
Great. Thanks, Ed. As a reminder to the audience, materials can be found in the document folder at the bottom of your screen. We appreciate your feedback. Please take a moment to fill out our brief survey, also located at the bottom of your screen. We will be taking advisor questions. Please type your question in the box under the media player window, and we'll get to as many of your questions as possible. In the event your question is not answered on today's webcast, a member of the Sprott team will reach out to you directly. If you'd like to have a conversation to further discuss the ideas that were covered during today's event, please click the blue confirm button in the meeting request box on your screen. And with that, I'll turn it back to you, Ed.
Thank you, Melissa. And what I'll try to do is just throw out a few questions as it relates to the energy transition side as well as the gold and silver side. And again, we recognize we're past an hour, and just again, a reminder that we will be following up with everybody's questions post this webcast. So the first one, since we just talked about energy transition, I think, Steve, would be a good one for you to address. And it relates to uranium. And that is, how large is the current stockpile, and what will that look like on the longer-term supply and demand gap?
Yeah, so I think I mentioned in my remarks that, coming out of the Cold War, we had a large stockpile that the utilities were able to draw on as we no longer had to store that material up. As we're moving forward here, though, and given not all the current utility needs, but also expected future production, and as more nuclear reactors come online, we're starting to see utilities really start to restock the reserves. So they're really almost racing in many respects to figure out and buy their future supply for the next couple of years, so that they know that they have what they need to operate their plants. It's for them it's a relatively small cost relative to the overall process of producing electricity, and it's quite a profitable one. So they're actually racing to increase those stockpiles, and that's in large part one of the reasons we're seeing the price action that we've seen with uranium. It's now to around $82 a pound or so, floating around that area now for a few days. It's not quite at the point where that's incentivizing a sufficient amount of miners to restart mines that might be on care and maintenance or to break ground on new mines. So we'd expect some higher prices to bring additional supply online.
Thank you, Steve. And Ryan, this is a good one for you. Anyone following the gold market as of late has seen it, break above 2,000 and then settle back down at or around slightly below 2,000. The question is simply, with these dramatic moves, can you give any color on the next, say, 1 to 3 year outlook, given the backdrop of the current economy? Any view there, Ryan, from a pricing standpoint? Not asking you to predict, but just get a general view.
Got it. Yeah, no, it's been an interesting time for gold. I think there's a few things that have been influencing the price. Obviously, geopolitical tensions. We first saw it with Russia, Ukraine. Now it's moved over a little bit to the Gaza area, and then also some other tension with between the United States and China, among others. So I think that's definitely played an influence in it. And again, I think it's showing central banks buying it, and I think other governments outside the central banks are buying it as well for their own purposes. But moreover, I think just that level of uncertainty in the geopolitical scene has helped gold, certainly. And I guess from an economic standpoint, you look at kind of the major economies of the world, so, United States, Europe, China. I think actually the United States has performed pretty well I think Europe has been a bit more muted, and China certainly a little disappointing in terms of the comeback most were expecting out of COVID. And so I think, there's a bit of economic headwinds, I would say, on that front as well. One of the things that I look at, as an indicator is the growth in money supply. And you can look at whether it's Europe or the United States, they're actually both negative, basically for the first time ever. And that's pretty scary, considering, really QE was first introduced, I guess, after the financial crisis of, 08, 09, to basically, make sure that money supply didn't decrease, in my mind. And so right now, I think you're actually starting to face some underlying economic uncertainty as well. And so from the gold price standpoint, I think both those things bode very well for gold. Obviously, I showed a chart earlier in the conversation showing about how resilient the gold price is in, economically uncertain times. And I think it'll continue to be that. And to me, I think it'll be increasingly the place that people view as the place to go. And I think the beautiful part about right now is that you don't have a lot of, I'd say, certainly retail investors, particularly in the Western world, who are there at all. We've seen huge declines in the ETF holdings over the past couple of years, down about 20, 25% or that period or so. And so to me, that's all opportunity. So, I think over the next several years, gold price will be going up. And how much and how fast, don't know. But the trajectory is certainly positive.
Great, thank you. And one of the questions I guess we'll finish up with, because I know we're almost a quarter after. This is kind of a hybrid question, actually. And speaking about central banks, this is kind of a unique question. It says, with central banks purchasing gold, do you see other metals, for example, copper and lithium, being purchased by central banks, given the importance of the energy transition? Not really sure what the answer is there. Maybe, Steve, you want to start with that. But I just think that's kind of a fascinating question. Never seen that one come across before.
Yeah, thanks, Ed. I think there's kind of two different aspects to that. One, I would say it wouldn't surprise me to see that at some point in the future. Something similar to what we've done with the Strategic Petroleum Reserve. But the other consideration that we have here is, we're at a position in many of these minerals where we're at a significant expected supply deficit for the foreseeable future. So I think the ability to maintain any sort of sizable strategic store of any of these minerals would be difficult. I wouldn't think it's out of the question as countries look to make sure that they have energy security.
Thank you, Steve. And, I trust we could go for another hour on the Q&A because they keep racking up here, which is good, and I'm happy to see we still have listeners. But in interest of everyone's time, again, I encourage you back on page 48 to reach out to your respective teams, whether you're on the key account side, the institutional side, or the financial advisor side, for any further questions you might have. And also know that we will be following up with everybody directly with their questions. So thanks again for everyone's time and attention. Enjoy the holiday season, and looking forward to working with you all in the new year.
Great. Thank you all for such an informative discussion. As a reminder, materials have been made available for download and can be found in the document folder at the bottom of your screen. We appreciate your feedback. Please take a moment to take our brief survey, also located at the bottom of your screen. In the event your question is not answered on today's webcast, a member of the Sprott team will reach out to you directly. If you'd like to have a conversation to further discuss the ideas that were covered during today's event, please click the blue confirm button in the meeting request box on your screen. Thank you for joining us, and enjoy the rest of your day.